So we get a temperature read on the audience. How many of you actually own a blockchain investment? That could be a cryptocurrency or any other kind of blockchain-related company. Hold them high. I'm going to say that's about half of you. So that helps us kind of figure out how we're going to talk about tokenization today. And what we want to do is kind of give you a roadmap, because there was a lot of information in that initial keynote. So I'm wondering if you guys can first of all kind of explain what is the new token economy? From a high level, can you just give us kind of a survey of the landscape? How do you describe it, Joel?
So when we talk about blockchain technology, not all of that involves the crypto side of the space. So the token economy is the piece of blockchain generally when we're taking blockchain or distributed ledger applications and putting on top of that different types of cryptocurrencies or tokens that get used either as part of how you make a blockchain application work, how you access a blockchain application, or how you buy goods or services in connection with the blockchain application. So it's taking these blockchain technologies and layering on top of it some type of role that a cryptocurrency plays in the process. I think that's at a high level what we mean when we're talking about the token economy.
Dr. Mola, how do you describe it to somebody who's new to this space?
Yes, I would like to make a distinguish between cryptocurrencies that serve as a mean of a payment, a store of values, and crypto commodities that that serves as a way to access a service within a network. And then as a third, the crypto tokens. They are issued generally via initial coin offerings on top of an application. And this third crypto token space is the one that is regulated by the SEC, and it's under the purview of the SEC.
So to think about this in three broad categories, to recap, there's digital currencies such as Bitcoin and what we call cryptocurrencies or altcoins. There's utility tokens such as Ethereum, and then tokenized assets, which would be tokenized versions of real assets such as real estate and so forth that we'll be talking about in our next session. Does that sound accurate?
It is generally accurate, although trying to figure out what goes into which category
is difficult.
It's often not easy. Different people, different countries define these differently. And part of it is also the cycle we're in. Everything in this world moves at lightning speed. And early on, when people were starting to issue their own cryptocurrencies, everybody said, this is utility, which is a made-up concept, by the way. There's no legal concept of utility, but everybody said, my token's a utility because it's going to be used in my platform. And it's true to the extent that you're using a token to spend, to buy and sell services, to get access. That really shouldn't be treated as a security in the way we traditionally find it. But part of it that was going on as well was that if everybody said my token's a utility, they thought that they could then sell it everywhere in the world without having to worry about regulation at all. So part of it was genuinely, it's really something different than a security, but part of it was also, if we call it this, we can avoid regulation.
So those are the three broad categories, but it's kind of loosey-goosey in between those categories, essentially. So we started this blockchain investor meetup last year, and I think at our first one, we had like a dozen investors show up. And then it grew and grew, and today we reached about 100,000 blockchain investors, as Kyle said. So there's this huge demand for investors to understand how this stuff works. And what I've noticed is that these investors tend to treat all of these blockchain assets like stocks. They think of them like stocks. Whether they are stocks or not, they're not. They're not stocks, but people want to buy them and hold them and sell them later at a profit. And isn't that the very definition of a security, is something you're holding on to, hoping that will rise in value on someone else's work? Dr. Mo.
Yes, so tokens, some of the tokens are very similar to stocks, but many and most are not. And so I think looking at the landscape, we have to say that not all tokens are created equal. And so if there is a study by Edani et al. In 2017, they looked at a large number of tokens, and they looked at the rights that these tokens were carried. And there are different, I mean, they carry different bundle of rights, combination of rights. There are some, most of them, 75% give access to a service. 50% just provide a form of payment within a network. 25% provide a share of fees or a profit. So only 25% of them, and less than 20% provide a sort of a governance participation or also voting rights. And some of them, 10%, are just mere contributions. Mm-hmm. So aside from this minor components, really only the minor part of the tokens really are very comparable in terms of to stocks.
Okay, I understand what you're saying, which is that they are not designed like stocks. But don't investors think of them like stock? Isn't the investor behavior like stocks?
Well, that's exactly why this is so complicated. So if you take, Simona's descriptions, a lot of these tokens are meant to be used for access or to buy and sell goods or service. That sounds like a currency, not like a stock. But here's where it gets complicated. A lot of people that sell these cryptocurrencies that are intended to be used as a means of payment or a means of access often sell those tokens before they've got a business. So maybe a year after.
So they're using it to raise capital to start a new blockchain project.
So even if eventually those tokens are intended to be used as a form of payment on a blockchain platform, when they're initially sold, in many cases, there is no business. And so if you're buying that token before there's a business, all you can do is either hold it and wait, or hopefully find another buyer that's willing to pay more than you paid for it. So from the SEC perspective, they say, well, you know what? I don't care if you're telling me that this is supposed to be used as a means of payment. At the time you're selling it, that really looks a lot like a security. It looks like a speculative investment. Mm-hmm. And on top of that, a lot of those tokens, when they're sold before there's a viable business, are not sold to the future customers, the people that are going to use those tokens on the platform. They're often sold to speculators and to funds. The folks that have no intention of ever using those tokens, those are the people that are hoping that the tokens are going to appreciate in value. They can flip them and make a quick gain. So again, the SEC says, yeah, okay, down the road, and it may very well be that in the future those tokens are not securities, but at the time you're selling them, in many cases they are.
So Mark talked about this being the biggest wealth creation opportunity in our lifetime. And I think if you look at these trading exchanges like Binance, started a year ago, and it's trading $1 billion a day today in these tokenized assets. So these are people buying and selling cryptocurrencies, altcoins, these tokenized assets today, $1 billion a day. Is this going to be the new stock market? Is this going to be the new New York Stock Exchange? Will they merge? How do you see all this playing out?
Well, if I have to dust off my crystal ball, I think...
you keep it somewhere where it gets dusty. I
don't think that, at least in the short term, there will be a New York Stock Exchange, a crypto New York Stock Exchange. In the short term, I think the SEC will continue to regulate exchanges and to the crypto exchanges. And if they trade security tokens deemed as a security, then they have to register as a national registered exchanges.
Or being sold pursuant to an appropriate exemption.
Exactly. And so, for example, just last week, there was a settlement on a cease order involving Ether Delta in exchange. And so this was the first really enforcement action of the SEC that went against an exchange that failed to register. And so I think in the medium term, given the regulatory burden, nowadays we have around 200 crypto exchanges. They are very much concentrated in the top 10 in terms of daily volume. So I think in the medium term, there will, just for the regulatory burden that represent a fixed cost, I see that the small exchanges will fail or will be merged or acquired by the large one, and there will be mergers.
There's going to be a great shakeout, and then it will probably consolidate into a few major players, which is probably the case across all of the blockchain industry.
But your question, I think, really is, what's the value proposition for these so-called security tokens? And there are a couple of arguments as to why it does make sense. And it's not that you're avoiding all of the regulatory points you raised. They're still there. But think of it this way. If you are able to instantaneously trade and settle a security using the blockchain, and we've eliminated this T+3 settlement cycle, that's a big deal. Not only does it create certainty as to who owns a share at any given time, but we're eliminating a lot of inefficiencies and a lot of costs in the system. Then there are other things that are potentially advantages once you try to start to issue a security in tokenized form. So for example, if you've got a private equity fund or a hedge fund, and you issue your shares, your partnership interests in tokenized form, you don't have to, as an investor, wait for the fund sponsor to redeem you out. If you want liquidity, you can simply sell your token on a token exchange. So that existing proposition where you've got to wait 5-10 years before you can get liquidity goes away. And if you're the fund sponsor and you're managing a portfolio, and you don't have to manage your portfolio to cash in order to meet future redemption requests, you can change fundamentally the way you manage your portfolio as well. So we start to look at how tokenizing shares can really start to have a significant impact in how we use security.
Yeah, because that's one of the great things is we're supposed to be able to program these things, right? They're software, they're code, they're smart contracts. And we're supposed to be able to solve a lot of the problems around the existing securities market by creating these smart stocks or smart securities that have features built into them to solve some of these problems. So you just named some. Dr. Mola, do you have other kind of solutions that could be solved by smart contracts?
Oh, the use cases are really infinite. We mentioned many of them before, but also in that looking at the outlook, we need also to consider the challenges and consider the risk. And that's what I think the regulators are looking at. They're not trying to regulate the technology. They're not trying to impede the economic growth related to the application of the technology. In my view, they're trying to police the landscape in a way to legitimize actually the use of the technology.
So this has been the dialogue in 2018 is around regulation. That has been the overarching theme, I would say, in the blockchain community. And how will it be regulated and when will it be regulated, et cetera. And it's ironic to me that we are the decentralized community and we are waiting on permission from a centralized authority. There's something that just doesn't work about that to me. So how do we lead? How do we lead the SEC instead of the other way around? What are some common sense guidelines that we can put forward out there to help the SEC understand what this is all about?
So let me ask a question. How many of you have ever looked at a white paper? So if you look at white papers, I'd put them into 3 buckets. One category where you need a couple of PhDs in physics to try to get through it and understand it. The other extreme are those that were close to or virtually fraud, where they would talk about how this is the greatest thing since sliced bread, and if you invest in our token, you'll be able to stack up your earnings all the way from here to the moon. And then the third category, which looked like they were written by Martians. So that's a great example. Just because some tokens may not be securities, or because we're not sure in the debate how tokens be regulated, doesn't mean that when you're selling something that's supposed to have value, that you shouldn't use basic common sense standards, good corporate practices, good governance practices in how you write a disclosure document as far as what you're selling, and how you tell people about the investment risks, and how you agree that you're going to provide ongoing reporting. So as a marketplace and as an industry, we don't need to wait for regulators like the SEC to mandate certain type of disclosure. They're just common sense business practices that have been lacking, unfortunately, in this space. It's starting to change, which is good, but it's been lacking that, to me, have been examples of the market shooting itself in the foot over and over and over again by doing really stupid things.
See, I agree with you on that. You're saying we need best practices, we need truth, transparency, and trust, right? However, I see it differently because I work with so many of these folks that I just think they're young and they don't know what they're doing. Like they don't know what they need to discuss. They don't know how to write a business plan.
It's true.
All they know is they got a great idea for a blockchain project. So I look at it differently from frauds and scams. I just say inexperience and youthfulness. And what we need to do is help this industry grow up. What do you think, Dr. Mola?
Yes, I have just recently the SEC has announced a new initiative. So I created an office called FinHub, and it's an office that really is a sort of a digital innovation center that tries to establish a channel of communication with companies, with entities that are trying to pursue an initial coin offerings, investors, participants. And I think this is the right way. It's a light touch approach to regulation. And it seems to me that instead other regulators have banned completely ICOs. So while the SEC has first trying to put a notice the participants with the report, the DAO report, and then police the landscape over time. It's not come up with a regulation, ICO, a regulation blockchain, or a regulation token. In my view, it will not come up with a policy action because this technology is so fast changing and the timing of regulation is long. I mean, in terms of proposal and proposing stage, final stage, adoption, when it comes to finalize a rule, things have changed. So I don't think the SEC will come really with an initiative, a policy initiative, but it will continue the role of educator and warn investors of the risk. And I think you have seen the How We Coin website, so the mock-up.
The SEC released a fake How We Coin website to tell investors what to look for in fraudulent ICOs.
Exactly. And also this role of really be part of this competence center. And I think it's really significant and striking that a regulator put itself in a really hub and opened this channel of communication.
Did anybody release a Howie coin after that website was launched?
No.
Would have been great marketing. Have the SEC market for you.
A quick route to jail.
So you are part of the Wall Street Blockchain Alliance, right, Jules? And you're developing best practices for ICOs, these new token offerings. Can you share with us some of your thoughts? You mentioned before this idea of kind of, truth and transparency and trust.
Right.
But what are some of the other things that you're trying to get out there in the ecosystem?
So I think we're fighting a little bit this utopian mentality that at least a portion of the players in the space have, which is that you can introduce this coin into the marketplace and then the community itself will just keep everything going the way Bitcoin operates, where there really is no central management team. And what we're trying to do is remind people that in most cases, even though we may be talking about cryptocurrency, we're still talking about launching and building businesses.
Yeah.
And when you're doing that, you have to look at things like management team,
yes,
governance, not just the community itself, but there really needs to be at least some role for a centralized or quasi-centralized governance that it looks like a traditional corporate entity. There needs to be, again, responsibility and reporting by some management group. There has to be financial information that's periodically provided. So we're trying to encourage people in the blockchain space to not give up this notion of decentralization because you're never going to win that debate with younger generations that are building this technology. But we're trying to remind them that you can still have decentralization, but put on top of that good corporate business practices that we've always relied on and that should continue to be there. So it's the disclosure, it's the ongoing reporting, it's management responsibility. It is putting in place different officer roles that have different oversight functions. Those types of what I would call common sense things that we would do if we were starting businesses outside of the blockchain area.
Kind of fundamentals of building a good business.
Yes.
Right? So at Bitcoin Market Journal, our investor publication, we've created the scorecard. And the idea behind this is to help investors do their own due diligence on new blockchain investment opportunities. We're going to hand these out to you guys. It'll be a free takeaway. And basically, you rate each one on various criteria like market and competitive advantage and management team and so forth. We have a team of analysts that go through all of these new token offerings, and we actually do this due diligence. We do this vetting. And I think that's very similar to what you're talking about.
By the way, there's one other important aspect, which is that because, as you talked about, tokens can represent different things. Some are very much like traditional equity and actually represent ownership, and they should be, when you're looking at a potential investment, you should make the same type of valuation and due diligence you would do with any other equity investment. But for all those tokens out there that don't represent an ownership, don't represent part of a capital table, don't represent necessarily a right to profits, from the investor side, you've got to think about different ways to actually do the due diligence and analyze those investment opportunities. And so the issuers need to clarify what it is their token represents and what they don't represent. But people that are investing also need to carefully look at whether or not the token they're buying truly is a security or something else that doesn't give you that direct ownership interest.
So we've got a room full of very smart investors and money managers. What do they need to think about building in terms of skill set within their own funds or organizations in order to do some of this due diligence and in order to help them vet carefully the new blockchain investing opportunities? Who do they need to hire? What do they need to build?
Well, I think the skill set should be diverse. Should be in part engineering, should be part economist, should be part legal. They should, and it's always fast changing. And it's not in this. I think in this economy, we need also to look at beyond blockchain. I mean, and look really in a more holistic sense what type of digitalization revolution we are in, and how blockchain can be combined with other technology in order to economic growth.
Yeah, I like what you said about economists, because I think there's a new job title emerging, which is like a tokenomist. You know, it's like an economist that understands token mechanics, essentially.
Well,
and I think that's going to be a very important role.
The value proposition behind many so-called utility tokens is a scarcity model. That the idea is you're going to only sell fixed number of tokens. And if those tokens are necessary in order to access a platform or to buy goods or services on a platform, if the demand for that platform and its services are high enough, people are going to go out in the market and look for those tokens, and that's going to push up the price. So it's a completely different economic model as to why there's value. It's not that you're getting, a profit interest or return. You're getting value because the demand is going to exceed the supply of the tokens out there.
One thing Mark talked about was the network effects and how that's driving so much of the value. And it's just an initial pass to see whether a blockchain investment is a good one. Can you just look at how many people are using the blockchain in question and use that as sort of a very first kind of filter on whether that's any good?
Actually, there are some, I think before we mentioned the Metcalfe law, but there are some methodology based on that that shows that the value, for example, of Bitcoin is explained, it's 94% explained by the number of users, the square number of users. And so, based on that projection, actually, there are some model that forecast the Bitcoin going to 10,000 within 2020. So that means that Bitcoin is very similar to social media, so the number of users. And similarly, also in the token economics, the fact that, for example, I think all Manchi Inc., that is this token that has been blocked by the SEC. But the idea of the Manchi token was really an app where really the internet app, really the app in your review of restaurants. But the idea was to give a token to the users that were also the people that were going to the restaurant, give reviews, and also use those tokens to pay for meals, and the restaurant would give back and pay for reviews. So created that really the virtuous circle of value that is based on the number of users. So you cannot really separate the value of the token from the value of the business of the application. It's really totally integral.
So I think if you take away one thing, it is that these blockchain investments have network effects. So they grow not exponentially, but polynomially. They grow like this. And as more people get on board, the values of those tokens and of those projects tend to accelerate more and more rapidly. Folks, please give a very big hand for Joel and Dr. Mola.